I'm Garrett Cayet, SFMG's Chief Investment Officer, here to check in after the second quarter and provide some of our thoughts as we enter the back half of the year. To start things off, market volatility returned in the second quarter, with the S&P 500 declining significantly in early April following the announcement of sweeping reciprocal tariffs. Fears of an escalating trade war initially sent the index down nearly 19% from peak to trough from the February 19th high. But those losses were largely recovered throughout the remainder of the quarter for a few key reasons. First, throughout April and May, the administration significantly softened their stance on tariffs, delaying many of the proposed tariffs and granting key exemptions. Then the recovery gained traction when Treasury Secretary Bessent reached an agreement with Chinese officials to reduce the tariffs on their imported goods, which eased the tensions further. Next, economic data and corporate earnings have remained resilient. Inflation has stayed relatively subdued, and better than expected earnings results from several major tech companies reinforce the optimism around the long-term potential of artificial intelligence. Eventually, market focus shifted to geopolitical risks after Israel's strike on Iranian nuclear facilities. Oil prices spiked briefly, adding to the volatility, but a ceasefire agreement and declining energy prices helped markets stabilize. And along the way, growing expectations for Fed interest rate cuts added another tailwind, ultimately propelling the S&P 500 to a record high before the end of the quarter. So the market's recovery suggests investor confidence in the economy's ability to absorb trade disruptions with limited long-term impacts. But there are multiple scenarios to consider. Trade disruptions may prove to be temporary with minimal economic consequences, or the ongoing uncertainty eventually does begin to weigh on growth, business operations, employment, and inflation dynamics in the latter half of the year and beyond. We think the current market levels are pricing in the more optimistic scenario. As we continue on through the second half of the year, we'll continue to evaluate these cross currents and trade policy developments to assess which market exposures we should retain and what areas it may make sense to increase exposure to, given the various risks that we see in the environment. Thank you for listening, and if you have any questions about your portfolio, please feel free to reach out to your SFMG team. Thank you.